Many people entered the equity market for the first time in 2020 and 2021 and immediately saw incredible returns with their stocks during that period. However, in 2022, many of those same stocks have gone into reverse, and now those investors are left bewildered looking at those large losses and wondering why. So in this video, we'll look at the reasons behind that, but more practically how to avoid it in future and generate good long-term returns. So let's look at how to avoid losing money with stocks in a bit more detail. When people start out in investment, they often assume it's about stock picking. And I've shown here the returns of the NASDAQ index, that's a US tech-heavy index, during the period when many people entered the market. So it began in March 2020 and it ended in December 2021. And it was a period of incredible returns. So what we're going to do to illustrate what stock pickers saw during this period is a set of random portfolios. We literally throw darts at a dartboard to choose which stocks to buy in what proportion. So each of the black dots you can see here is one of those random portfolios. There's also a big red dot here, and that's the risk and return of the NASDAQ 100 index. Now what's pretty surprising about this is that all of the returns for these portfolios were pretty good. In fact, they were incredible. So return is what you can see on the y-axis, and even for the worst portfolio, it wasn't much less than 110%. You'd have doubled your money with that portfolio over this period of time. And for the very best portfolios here at the top of the graph, you can see that the returns are above 150%. So that is a very uncharacteristic period. Usually returns would be much more subdued. And in fact, what you can see on the graph is that many of the black dots are above the NASDAQ. So all of these investors would have assumed they were great stock pickers. After all, they beat the NASDAQ 100 and they generated incredible returns. Some of them even had lower volatility than the NASDAQ itself. So not only were their returns better, they were better on a risk-adjusted basis. Now, of course, at one point, the party ended. And if we look at the period between December the 27th in 2021 and January the 27th, 2022, everything went into reverse. So the NASDAQ, which is still the red dot here, actually has a lower loss than many of these portfolios. And these are exactly the same portfolios that we saw earlier. So this is why I think many people are now in this situation where they assumed they were great stock pickers, but in fact, they were simply buying into a very strong equity market rally when almost any stock selection would have done very well. If you want to dig deeper into the concepts of alpha, beta, index investing, then you can do that as part of our Patreon community. Plus, you get access to all kinds of goodies like a growing library of members-only videos and access to our chat application Slack, where you can chat to me and other members of the community. We also have a regular call for members where you can ask questions live. To learn more about that, just click on the link beside me and in the description beneath me. I think the confusion for many people is that beta is not the same as alpha. So what do we mean by those Greek letters? This tweet from Robin Wigglesworth at the FT makes a joke about it, but many people look in the mirror and they just assume they're a great stock picker after investing during one of those rallies. However, what we really have to do is to tease apart how much of our performance was simply because markets were rising and how much was due to our very good stock picking. And in finance, those two numbers are called alpha for your stock picking skill and beta, which is your market tracking return. Now, usually any portfolio in equity will be dominated by beta. In other words, the upward drift of equity markets over a very long period of time, which we can see here for the S&P over the last 150 years. Now, the top panel makes it really difficult to see the returns. They just seem to go up exponentially. So what I had to do was do a log plot so you could actually see the returns more clearly. And this steady trend, although it does of course have crashes during periods of volatility, shows that the return when you adjust for inflation and also reinvest dividends was 7.1% on average over this huge period of time. So that's why beta is so important. It generates a good, long-term, steady return, although there are of course market setbacks which you have to kind of ride out. So the return on any stock or fund or portfolio can be broken down into these two numbers. Stock picking generates alpha, if we choose the right stocks, and that's outperformance whatever happens to markets. So even if markets move down, alpha should still be positive if our stock selection is good. But beta is just market tracking. We just buy an index and we track its drift upwards. Now, if we buy an index fund, a passive one, beta is defined as 1. We literally make 1-for-1 percentage returns according to what happens to the underlying index. So in the case of those random portfolios, a lot of the return was simply generated by beta. Beta was roughly 1 for many of those stocks or close to it. For some stocks it was greater, so by chance you could have been lucky and picked the ones which outperformed. Another option during a very strong market rally is to increase your leverage. In other words, what you're doing is gradually increasing the beta handle and multiplying up the stock market returns. So why don't we just always increase leverage? If that increases our returns, surely that's a good thing. If we look at a fund like TQQQ, which gives you 3 times the daily return of the NASDAQ 100, you can see the returns during that period of that fund in red. And in fact, over this period, it almost increased your investment tenfold. Whereas a beta 1 fund, like a simple NASDAQ tracker such as QQQ, would have only doubled your money over that period. So it seems as if leverage is a no-brainer, until that is we look at the period when markets went into reverse. Because not only does leverage increase your gains, it also increases your losses. So TQQQ actually gave up a lot of its gains during the first month of 2022. So that's why these rallies are actually a leverage honey trap, where people think, I could have got this much return if I'd have levered up. So late in the market rally, they lever up their portfolio just in time to lose money during the downturn. Also, with leverage, it's very difficult to stomach the very large losses you make during market down moves. So I think for many people, leverage is simply unnecessary because it also increases the temptation to sell in a down move of markets, and that usually crystallizes losses. In contrast, harvesting alpha, that's the stock picking outperformance, is very difficult and usually quite expensive. How do you actually do it? Well, of course, you can do your own research to look at stocks which you think will outperform the broad market. That might be because they've got very good fundamentals, they've got very strong balance sheets, or a very strong business model, or you could rely on other people's research in order to generate your stock picks. So for example, in 2020 and long before, many people were listening to Jim Cramer, who has a show Mad Money on CNBC. Now he's very entertaining, he has lots of whistles and bells which he has during the show, and he talks about single stocks. He tells you which ones he likes, which ones he doesn't, but the record of his stock selection is a little bit patchy. And in particular, when we did see that market downturn, his stock picks were particularly hard hit. The same goes for Chamath, who popularized SPACs in 2020 and 2021. And if we zoom in on those two tables, with Jim Cramer on the left and Chamath on the right, you can see that all of those returns, with a very few exceptions, were deeply negative in the recent sell-off. And of course, there are many YouTubers who also tell you about the stocks which they like and which they buy in their portfolio. Meet Kevin is one of them, but you can see that his portfolio has also been affected by this market downturn, with some pretty big falls recently. Another choice for many investors is to buy an active fund. Instead of paying a very low fee for an index fund, which passively tracks a benchmark, that's just beta, you pay an active manager for their stock selecting skill. And if they're worth their salt, they'll generate alpha both in up markets and down markets. Now, the global index company S&P Global Indices creates this survey, which is called the SPIVA survey. It's the S&P Index versus Active report. Here are the results over the last decade for the United States. And what you can see is that 83% of the fund managers failed to beat their index, the S&P 500, net of fees. Yes, you heard that right. That's a 1 in 5 success rate. And yet they charge a fee despite the fact that they often don't beat the index. And just to show you that it's not just the US where that's true, If we look at Canada, the story is very similar. 83% of the time, fund managers in Canada underperformed over the last decade. It happened 85% of the time for European fund managers and 86% of the time for Australian fund managers. Now, some people think that in emerging markets, markets are less efficient. In other words, all of the information isn't already baked into the price. So very careful stock selection should outperform in emerging markets. But if we do look at countries like India, the evidence for that simply isn't there. In fact, the underperformance is 83% for Indian stocks. And that's over a 5-year period because records are shorter for the Indian market. Now, beta and alpha are very different. Because if we want to harvest beta to monetize those beta returns, it's actually very easy and cheap. In fact, all you have to do is buy a global equity index fund and keep your money there for as long as you possibly can and do absolutely nothing. Rather like my friend Teddy here, who's my cockapoo. He spends most of his time doing absolutely nothing, but occasionally he does look at his portfolio. And if you want to look at some examples of funds which allow you to harvest beta, then you can look at this video which I made called Best Index Funds for Global Stocks. And in that video, I talk about how cheap it is and also discuss various alternatives for getting that global equity exposure. In summary then, it's very difficult to generate alpha. Even professional fund managers who are very well resourced, who have their own Bloomberg terminals, who have their own research teams, even they who live and breathe the markets fail to beat those markets about 85% of the time over a 10-year period. Now, I think it's even less likely that a YouTuber will be able to do successful stock selection. So I think stock picking is probably not the best way to go for many people. A much better way to do it is to simply buy beta, buy it very cheaply, and simply drift upwards with equity markets. Use the Teddy strategy and do as little as possible. And remember our Patreon offer. You also support us if you do that, and you get to learn from our vibrant Patreon community. And remember, there'll be a link about that above me and in the description below me. And as always, thank you for listening.